My name is Jamshid Hosseini. I'm the Director of International Business Studies here at Marquette University. Please allow me to introduce Dr. Linda Salchenberger, James H. Keys, Dean of the College of Business Administration and Graduate School of Management, for opening remarks.
Thank you very much, Jamshid. I've actually been looking forward to this event for a lot of different reasons for a very long time. I can't imagine a more relevant topic and something that, when I think about it, we've been discussing for 5 years, since 2007. So we've been watching the financial crisis unfold: Ireland, Greece, Spain, Italy, Portugal. There's been an ongoing and very vigorous debate about what will happen next and what the solutions are for Europe and potentially the US. How many of you know what sovereign debt is? Okay, will they know by the time they leave? So it's many of these topics that didn't really catch the public interest in the past are things that we're all paying attention to right now. Our own markets seem either to overreact to the slightest change in what's happening in Europe, or we sometimes think that everything is working out just fine, and we sort of carry on as if nothing is taking place. So I am very much looking forward to hearing what the panelists have to say for that reason. Secondly, it's really wonderful to see so many students here. You know, you have a true vested interest in the policies and in the strategies that both the private and the public sector are going to be taking in the next several years. So be sure to ask our panelists a lot of challenging questions. In any event, this is a very timely topic, and I believe will stimulate a lot of discussion in and outside of the classroom for you. So I want to thank a few people. First and foremost, I want to thank the Dean's Council of Excellence. About 18 months ago, we established a Dean's Council of business leaders really across the country, and the purpose of that council was really to be actively engaged in the life of the college. One of the strategy groups in the Dean's Advisory Council is the Global Perspective Group, and that group felt it would be extremely important to provide an opportunity for our students and other business folks to hear about some interesting topics like this. So Sue Harnett, Pat Bartling, Maureen Oster, Greg Ryan, and Mike Van Handel, who's also a panelist, I want to publicly thank them for coming up with this idea and working with Dr. Hosseini to make this happen. A lot of the other council members have expressed interest and their support, so we're quite happy about that. So it's a great example of us working together with the council. Another person we want to thank is Dr. Jamshid Hosseini. He's led our international business major for many years and is truly an international ambassador to the college, on the road most of the time, trying to find new partnerships and new exchange student programs and opportunities for our students. About 1/3 of our seniors who are graduating this year have traveled abroad, and he said, I can't leave the podium without mentioning that our graduate program was ranked number 22 in international programs this year, and our EMBA came in at number 15 according to the latest U.S. News graduate programs ranking. So thank you, Jamshid, for all of the things that you do for the students and for the program. I'd also like to thank our panelists. They'll self-introduce in a minute. Andrew Bush is from Global Currency and Public Policy Strategist from BMO Capital Markets. Euless Payne is a trustee emeritus of Marquette University. Addison Clifton and Mike Van Handel, Executive Vice President and CFO for Manpower Group, and Mike is on my Dean's Advisory Board. So thank you to each of them. And in a moment, Dr. Hosseini will introduce our keynote speaker, Dr. Freddie Vander Spiegel, Economic Advisor, BNP Paribas Fortis, and Professor of the Free University of Brussels and the Verlick Management School. Finally, Deb Reeder, who is in the back, and Mandy have, as always, been an incredible support for an event like this, and we thank them for their important role and everything that they do for us. So with those few remarks, I'll turn it back over to Jamshid, and we'll get the program going.
Okay, the rest of the program will have what we call the keynote speech. And in a moment, I introduced a little bit further the keynote speaker. And then immediately after that, we moved to the panel discussion. We decided that the time was too short to actually have a break. In between the keynote speech and the panel setup, please feel free to, to relax and then maybe get back to the seat quickly so that we can continue the discussion. After the session, I hope that you will have time to stay around. There is some hors d'oeuvres in the hallway, and I hope that you will be able to continue discussions or ask questions from the panelists and the keynote speaker, those who can stay with us. Now let me introduce the keynote speaker. Dr. Freddy Vandenspiegel is economic advisor at BNP Paribas Fortis Bank. He's also a professor at the Free University in Brussels. He's been a visiting professor to Valeric University in Belgium and to Warsaw University in Poland, as well as several other European and US institutions. Dr. Vandenspiegel serves as the economic advisor to BNP Paribas Fortis Bank. He actually was the chief economist before switching the role more to the professorial role and more taking on the advising role to the BNP Paribas and Fortis. He served as managing director, Belgian, Luxembourg, and French investment funds, board member of Brussels Stock Exchange, trainer for Eastern European bankers and commission, which is commissioned by the European Commission, board member of European Federation of Mutual Funds, chairman of the consultative panel of Committee for European Banking Supervisors, and member of the international or interinstitutional monitoring group sponsored by the European Parliament and European Council. Dr. Vandenspiegel, the podium is yours.
Yeah. Thank you very much for this kind introduction, ladies and gentlemen. I'm happy that you're all here despite the very nice weather outside, because the subject we are going to discuss here this afternoon is not really a very pleasant subject. It's about crisis. And this crisis which we are talking about is a crisis that is quite special. As economists we are used, and as investors we are used to crisis. It's something that comes and that goes. It's together with the business cycle. You know, the 7 fat years, the easy years, and then followed by 7 meager or difficult years. It's the normal human cycle of behavior, but this crisis is totally different. And what I would like to do in the next 30 minutes is, first of all, start with the big picture, asking the question, why is this crisis now so different from all the others? And then we are going to the second point that I would like to discuss with you, and that is what is now specific for Europe about this crisis, because despite the fact that the crisis started in the US, the effects on Europe seem to be more important than on the US in the meantime seeming to recover from the crisis. So Europe is in a bad shape, and we are going to see why this could be. And then the third part of my presentation, very briefly, is the consequences of this analysis of this crisis for Europe, for the US, and for the rest of the world. Now, in my mind, first point, why is this crisis so different as all the others? Because normally a crisis is, you get a surprise, you get a downturn of the economy, 3, 6, perhaps 9 months, the economy suffers, you get unemployment, you get all kinds of unpleasant effects, and then after 1 year, automatically it seems to be the invisible hand is leading to recovery, to new hope, and to new bubbles, waiting until the next crash. That's normally the cycle of economic growth and of the financial markets. But this time it's totally different. And why? Well, I think it is different because this crisis is the result of a changing world. And what is the world that changed? Well, it is the world design, the model along which the world was designed since the Second World War. This is history, of course, but it's always, if you try to understand what's happening today and try to have an idea what could happen tomorrow, it's interesting to look at the past. If you look at history before the Second World War, Europe and essentially the United Kingdom was the dominating economy. The international reserve currency was pound sterling. And with the colonies, the United Kingdom was really ruling the world. And then you get one World War for 1940, 1918. You get the Second World War, 1940, 1945, essentially European wars, but where the rest of the world was also involved. And after 1945, Europe has destroyed itself very successfully. And at that time, as in history all the time, when one major power is destroyed, a new power takes over, and this time it was, of course, the emerging economy of that time, the United States. From 1945, we see the world dominated by the US from a financial, economic, military point of view. The world reserve currency becomes the dollar, and we see all the major international institutions coming to this side of the Atlantic, the International Monetary Fund, the United Nations. So the world becomes a United States dominated world. Now you had, after the Second World War, also another winner of the war, and that was Mr. Stalin of the communist regime in Russia. And he did not appreciate how the US would have or prefer to organize the world, so he said, I'm going to isolate my part of the world in agreement with the US, Treaty of Yalta, and they split the world in two nice parts, the communist world and the free West. And Western Europe was happily under the umbrella of the US. Central Europe and Eastern Europe came under the umbrella of the communist regime, and you get an iron curtain in the middle of Europe. Now this was the model, and we had then, if we talk about the world and the free world, well, we are talking until the 1980s about 800 million people. North America, Western Europe and Japan. And 5 billion people are not considered to be part of the free world. They are all or communists behind the Iron Curtain, or underdeveloped, the old colonies of Europe that have been liberated. So that's the world order until the 80s. And then the world changes. And it changes because of two major things that happen. And always the world economy over 5,000 years changes when you have this kind of events. And the first event is a technological revolution. It's the same thing as inventing the wheel, or inventing and discovering iron, or inventing navigation, or the steam engine in the 18th century. Each time you have such a major invention, a technological revolution, the world power shifts. Some economies that were strong in the old technology fail, some because they are not able to adapt to the new technology, and some new economies take over. And this happened in the 70s, and the technological revolution is ICT. It's as important as the Industrial Revolution because it is fundamentally changing our whole life. All the products that now we consider to be essential, like mobile phones and GPS and flat screens and digital equipment, 20 years ago they were not even invented. But today they are dominating the world economy. They dominate how we live, they change how we communicate with each other, how we work, they create new products, and that's what changes the world economy. So you have technological revolution, and the consequence is that in a technological revolution you create opportunities. Because from that invention of ICT, as we call it, information and communication technology, you have all opportunities to try out and to find economic products out of this idea. And in such a period you need creative minds. You need people like Bill Gates. 20, 30 years ago, starting with the silly idea, I'm going to build a world of software while there were hardly computers. But you need them, and 20, 30 years later, he's the richest man in the world. You need people who invent Facebook, who invent Google, and in a couple of years they become rich and powerful. Now, for a communist regime, which is centrally planned, you cannot be creative. Centrally planned economies are strong in continuing the past. Building railroads, building highways, that's very easy to plan with good engineers. But developing something out of the blue is impossible. And the last president of the communist regime, Gorbachev, and his advisors were aware of that they were losing power against the West. And Mr. Gorbachev, end of the 80s, says we have to stop here, we have to adapt to the free world, to the free market system. It's more powerful, it's better adapted, and the Iron Curtain falls. And immediately Central Europe becomes Western Europe, and Russia is in the middle of turmoil, and China says we are not going to give up communism, but we are going to combine a strict communist regime with the most free economy, the most liberal economy in the Southwest, in the Southeast. A very pragmatic combination. I don't know if Karl Marx would be very happy with that combination, but it's quite successful. And Latin America wants to join, and suddenly the world economy becomes a theater for 6 billion people and no longer for 800 million for the happy few. And the result is that you get, of course, to globalization. Globalization making one integrated world. And that globalization was very positive and effective for everybody. Because on the one hand, we had cheap labor available from China, from Latin America, and cheap labor meant that all the products that from now on we were outsourcing and delocalizing for production to these new countries became cheaper. So there was no inflation. Because there was no inflation, interest rates could come down. Because interest rates came down, all investors were genius. It was very simple. You had to be stupid to lose money. Because what did you have to do to make double-digit returns? Well, if you look, for example, at the interest rate, the red curve here, that's the European interest rate. 10% in 1990, and now we are at 1.5%. So in order to make money, what do you do as an investor? You buy a silly government bond in 1990 with a coupon of 10%. You sell it 2 years later. You have your 2 coupons and a capital gain on your bond. So you have double-digit returns. And in 1992, you buy a new stupid government bond. You have twice your 9% plus a capital gain on your bond. You have double-digit returns. So this was, and then all these CEOs and the asset managers, I was one of them, said that they were geniuses. No, it was the Chinese and cheap labor that helped them to bring the interest rates down. Interest rates down, which means that you have double-digit returns. Problem is, for the whole world, we are now at 1.5%. It cannot come down again with 8%. It's over. The party is over. So this is not a crisis, it's a shift in the world economy. And what we have had then is during 20 years that we enjoyed this party of globalization with win-wins for everybody. Now in the meantime, in this globalization, money became so cheap. China is saving 50% of its GDP, while on average the world is saving 10 to 15%. They say 50%. And all that money coming from China and other countries is flowing over the free world. And Greenspan, the predecessor of Bernanke, the governor of the Fed, already said there is an Asian savings glut. And all that money was invested in our markets to buy our companies, and all that pushed up the prices of all assets. And because all that money was available, interest rates came even more down, and everybody could start to buy houses because of low interest rates. Because everybody could buy houses, housing prices went up, and everybody was rich. Okay, so this was the happy times. Now, if you look then now at the consequences of 20 years of a big party, of course, there is always an unintended consequence. And take here, for example, the US, the current account of the US. Since the start of the big party, which Mr. Bernanke today calls the big moderation, it's very strange, but this is the big party, the US gets into a structural current account deficit. Structural current account deficit that is financed by printing dollars. And then someone has to accumulate the dollars. Who is then accumulating the dollars? That is the debt of the US. According to the Federal Reserve, minus $8,000 billion. 8,000 billion. Who is now accumulating all these dollars? Well, here you see the new candidates to accumulate dollars. Is the Chinese central bank. They sit on a pile starting from zero in 1990, and now they have about $2,500 billion in their central bank. So the big owner of all the debt of the US, and also of Europe, because for Europe there are no similar statistics available, but the situation is the same, is China, and it's not only China, is the new world. This is a problem. Now, you see at the same time the financial sector growing like hell. This is financial leverage. Because of low interest rates, because everything goes up, banks become huge and everybody makes profit. So all the brilliant minds of universities want to work in a bank because there you have big bonuses. And the banking sector is growing and growing, over-leveraged, ready to collapse. This is what happened over these 20 years. And then finally, the world, the planet, is giving us the sign that probably if all citizens in the world, 6 billion, all want to have cars and airco, that then there's not oil enough for everybody. The global warming debate starts and the oil prices go through the roof, and that ends the final story. And then we get the trigger, oil prices go up, suddenly inflation comes back, interest rates go up, and it starts with the housing market in the US that collapses. And this is now the crisis. So this is not a normal crisis, but it's a crisis that started in 2007 and that is now gradually leading to a regime switch. 2007, mortgages, the subprime mortgages in the US, 2008 banks worldwide, 2009 recession worldwide, 2010 we see the first sovereign risk, countries go bankrupt, no longer exotic countries in Latin America or the Far East, no, it are OECD countries, highly industrialized like Iceland, Ireland and all the others. And then by 2011 we have start asking questions about the Europe and the future of the euro. By 2012 it becomes critical for Europe. So this is the framework in which we have to look at the crisis that we are living today. Now, what is now so specific for Europe? Well, it are three types of weaknesses. The first weakness is the political weakness of Europe. Political weakness because Europe is so complicated. Europeans have made a very complicated thing out of Europe. It started very easily in the 50s as a group of 6 countries under the pressure or inspiration of the US to bring 2 sectors, coal and steel, energy and steel, to a supranational level. Very easy. And then out of that idea in the early 50s came then a couple of years later the idea, shouldn't we enlarge the supranational level, not only coal and steel, but all economic aspects, and we create the European Economic Community. And then after some years, from 6 we go to 9, from 9 to 11 countries. The colonels in Greece, which was a dictatorship at that time, leave the country, and Greece becomes part of Europe. Spain, with the last dictatorships of Europe, Salazar and Franco in Portugal and Spain, leave the country and they come to Europe. Then the Iron Curtain falls and all Central European countries come to Europe. And now we are with 27. From 6 to 27, from only coal and steel to all aspects of life, because now it's not a union, it's not anymore a community, it's a union, even a monetary union. And there are new candidates waiting to get in. All these very fancy countries in the Balkan, well, they are all waiting. They are in the queuing line to get into the European Union. Nobody in Europe understands anymore who is member and what is the quality of his membership. Some are in the monetary union, some are in the economic union, some are in the political union, some are in the economic area, and all these diplomats and these politicians are discussing in Brussels, which becomes a kind of a center of Europe. Now the US has also had this kind of problems in the late 18th century, the times of Hamilton and Jefferson, asking what is now the role of the federal state and what is the role of the state, and how is the sovereignty of the states going to be organized in a coherent way with the power of the federal state. And it was even leading to a civil war, which you also certainly remember, until 1865. So this process of building a united continent is something that is always painful and at risk. And it's a very diverse, here you see the 27 member states. You have member states where the income per capita is 50,000 euro, and you have member states like Bulgaria where it's only 5,000 euro. And it's all in that same union, extremely complicated to manage. Now, if you look at the result of that union, GDP growth, it's not too bad. Despite all the pessimism of Europe, it's quite good. 2%, and on average it's a little bit lower than the US, but the US is a young economy with a growing population, while Europe is a little bit aging already, so it's not so terribly difficult or different, the result of this all. But it's extremely pessimistic. This is consumer confidence in Europe. When you ask to European households, what do you think of your situation in 3 months? Well, if you are at 0, they say more or less the same. You see over 40 years, they're always saying bad, worse. Only 2 times in the 40 years they said perhaps it could remain the same, and that was always the start of a crisis. So we should be happy when Europeans are pessimistic. Okay. Now, the result of all this is that in that political debate that was changing all the time, that Europe did not have the courage to build a federal political union. And that Europe is still 27 countries which all are sovereign. And for this crisis, this was a huge problem. Because the result was that when the crisis hit us, we did not know what to do. Each country tried to find solutions individually. There was no structure centrally. There was no power centrally. There was no money centrally. There was hardly a central bank, but that in the Treaty of Maastricht had a very strict role and could not do what the Federal Reserve, for example, could easily do in the US. So Europe was not prepared. The political problem and weakness of Europe. The second weakness is the economic weakness. And the economic weakness is that if you look at the consolidated level of Europe, it's not too bad. Europe and the Eurozone, they do, on average, on the long term, not so bad, certainly not in comparison with the US. China and the other countries, it's another story, of course. Government debt, yes, is going up, but not like the US. It's under control because there's discipline in Europe. If you look at the competitiveness, the current account, it's a balance. It's a perfect economy, which is competitive. So it's all very nice. But it's very nice at the consolidated level, but not if we go back to the country-by-country level. And each country over the last 10, 20 years has chosen other politics. Some countries, like yearly see the statistics of 2 years ago, because economists tend to have a very short memory. When then you got to the analysts like Capital Economics, a very famous consulting firm, they said the champions of Europe in growth are number 1, Greece, number 2, Spain, number 3, Ireland. And the lame ducks are totally at the right, Italy and Germany. The lame ducks. These are the bad economies. 2 years later, you see the world upside down, and that's this crisis. So just to say, don't take care of what economists say. Because 2 years later, the reality is totally the opposite of what they told you. Okay, now, what did Germany do to get growth? Well, they said, Deutsche Gründlichkeit, austerity. We are going to stop increases in salaries, we are going to create flexibility. And the loan costs in Germany did not move over the last 10 years. Other countries, and the result was that they started to be, of course, competitive because salary cost, unit labor cost did not go up. And export starts to grow as the engine of growth for Germany. Germany, for Europe, is little China. What China does with the US, well, Germany is doing the same thing with Greece. Now, the problem is that the agreement between the US and China is stronger than the agreement between Germany and Greece. That's the problem. Because China is buying up all the debt of the US without complaining. Well, Hu Jintao sometimes said that he's not very happy, but he continues to buy all these dollars that Mr. Bernanke is printing. While Germany, Mrs. Merkel, is sitting on her own savings and refuses to give her savings to the Greek who need them. That's the problem, the dilemma of Europe. Now, if we look then other solutions, well, some countries said, let's make our economy grow based on government debt. That's Mr. Obama's solution also for 5 years. Yes, we can, from 60% to 100% debt. Now, the problem is that later on someone has to pay back or go bankrupt. Some countries like Greece, they looked for the government to bring growth, and they are bankrupt. Because they are so big, small, so you're easily bankrupt. If you're bigger, it's difficult. Others said, let's bring more credit to the private households. Facilitate consumer credit. The US did that, and Ireland did that, and Spain did that. And the consequence is that you get housing bubbles. So these are the housing bubbles that then burst. So you have one side of Europe, strong austerity, low-cost Germany with good quality, good prices, and strong in exports, and part of Europe which we call Club Med, all around the Mediterranean, who have other economic models, but which collapsed during the crisis. And the result is that all these other countries, since 10 years, all became incompetitive, a little bit like the US. You have within Europe a huge exporter, that's Germany, and that all was done in 10 years. So this makes me a little bit optimistic. As it was done only in 10 years, it is not a problem of 100 years or of cultures. It's only 10 years ago that these fundamental mistakes were made. So if we could forget about the last 10 years, you don't have these excesses. So we only have to correct the last 10 years, not 20 years, and not going back to the Middle Ages. Because that's now very popular in the Anglo-Saxon analysis of Europe. It's a lost continent, and it's since years, and it's no, it's 10 years where the fundamental errors in economic design were made. And then you see that these weak countries, if you have a scorecard, well, the more you go to the right, the more red cards you get, and you see that some of these countries, everything is red, and that's Greece, that's Ireland, that's a little bit Spain and Italy. Okay, so this is how we got into this huge problem of divergence within Europe, despite all the treaties. And then we have the third, or the second, or the third problem, and the third problem is the banks. Banks in Europe are oversized. They are very big, and you get all the new regulations. Banks in Europe, for example, if you look at their balance sheet to GDP, it's about 300%. If you compare that to the US, banks' balance sheets to GDP are 80 to 90%. It means if banks in Europe and the US have the same problem, that the effect on the economy in Europe is 4 times bigger than the effect in the US, because you have small banks relative to your economy. The US is a typical market-funded economy where corporates and a lot of things are happening through financial markets, and very few things remain on bank balance sheets. In Europe, you have huge bank balance sheets and few markets. And because of these huge bank balance sheets, where you have all these bad assets because of the crisis, these banks suffer and tend to collapse. Here you see, for example, over the last 10 years, the evolution of the loans given to the corporate sector. In the US, it was, from US banks, 1,000 billion in 2000, it's still 1,000 billion. In Europe, it was already 3,000 billion, and it's now 5,000 billion. So these European banks, being so big, are a danger for the economy and for the countries. So that's the third problem of Europe. And the problem is the interconnection between the three. Because Europe is not a federal state, the interconnection is that if a country gets weak, like Greece or Spain, well, by definition, its banks are investing in local government bonds. So by definition, the banks become weak. Then the banks have to be rescued. Who is able to rescue the bank? It's the government of the country, who has then to pay to put more money in the banks. But because it puts more money in the bank, the country weakens. Because it weakens, the banks have more losses. And you get a downward spiral that is very difficult to break. So that's the headache of European politicians nowadays. And here you see the dramatic events of the crisis, where until 2006, one of the countries with the lowest unemployment rate was Spain. And Germany was one of the highest. Germany was at 10%, Spain at 6%. And then the crisis comes, and suddenly unemployment in Germany goes down to 6%. Mrs. Merkel says, I have done it. It's not right. Why is the unemployment in Germany going down during the crisis? Because China has pumped so much money in its economy to build new investments, and for these investments they needed high-tech machinery. So they needed German machinery to build the investment capacity. So it's the Chinese who have rescued Germany. But the Spanish, their housing sector was in collapse, and the only thing they can offer to the international markets and the Chinese are tomatoes and olives. And the Chinese don't want them. So they are the Spanish with all their tomatoes, and Germany is now full employment. Now in Spain you have unemployment of 25%, and in Germany 4%. The question is, can you live with the same currency in two such different countries? That's a fundamental question. Well, and then, of course, everybody sees what happens. You have the crisis and you have all the reactions. And the reactions are, first of all, we are going to rescue Greece. Too late, too little. It has taken too much time, but now it's done. You have a rescue fund, solidarity, fiscal solidarity among all the Eurozone countries, with about 800 billion euro available to rescue small countries. But it's too late for Greece. Second, you impose austerity on the weak countries. Bad choice, but Mrs. Merkel insisted. So a country like Greece, already starving, Mrs. Merkel says austerity. Well, if you're starving, you're not going on diet. And so that country collapses totally, and now you get political problems. And then the third element, which is the most important, but it's not helping for the short term, that's political reform in Europe. And political reform means that in the meantime, last year, everything that has been decided in Brussels is to make from Europe something that gets quite close to the US, with a strong federal state, discipline on the individual member states, and central planned fiscal solidarity. Now, that's all fine, but the problem is there still democratic support for these reforms? And that's something we will find out. We see now in France, Mr. Hollande, what is he going to do? Marine Le Pen in France, almost 20% votes against Europe. We see the same in the Netherlands, we see the same in Finland, we have seen it in the past. Each time that Europe is in crisis, you see that anti-European movement winning, but then until now, each time it has not really led to the debacle of Europe. Okay, so conclusion, this is Europe. Will it get back on the road? I think with what politically has been decided today, it will be back on the road, but it will be difficult and with a lot of political surprises. In the meantime, of course, we have to take into consideration that revolution of the world since the beginning of the crisis. And there, for the Western world, because the crisis is a Western crisis, China has no crisis, Brazil has no crisis, Russia has hardly a crisis, it's the US and Western Europe, and Japan already since 1990. That's where the crisis is. It's not a worldwide crisis. The other countries are prospering. So there we have to find solutions, a new design taking into account the reality of globalization. And the reality means that we cannot continue like this. One country, because it has the world reserve currency, printing dollars to get out of its problem and saying the dollar is my currency and is the problem of the rest of the world. This is a solution that is not possible anymore. And you see already the new countries like China saying we want to not get rid of the dollar, but we want to change the monetary system worldwide. We want to have more influence on the IMF and the World Bank. We want a new design of the world. This is a world that is not sustainable. A number of exporting champions like China, below, and Germany exporting almost as much as China, but China is 1.3 billion people and Germany only 80 million. And then one champion of imports, and that's the US, paying all the imports with dollars that are printed. This cannot continue. So we need solutions for this world, because otherwise we will go from one crisis that destroys the West and weakens the West to another one. We have reached the limits of the model after the Second World War. And this is a huge exercise. In the meantime, the world gets from the illusion and the enthusiasm of globalization, becomes nationalistic, protective, where if you look the Financial Times, it's about trade wars, it's about currency wars, it's about capital controls, Argentina nationalizing companies, it's about who is now, how are we going to stop the Chinese from exporting? Are the Chinese not dumping? Don't we need protection to keep our jobs in our country? So you see back to the world before the 80s, nationalism, protectionism. Even within the European Union, where Spain and Germany are fighting and getting to protectionism. I don't want to make you depressed, but it resembles the 1930s. And if you look at the similarities, you would say we are now in year 4 of the 1930s. Where exactly the same movements from a banking crisis, from a stock market crisis, to a banking crisis, to economic crisis, to inflation, deflation, to political reactions, and then to extreme left, extreme right, protectionism, and then we are going further on that, in that direction. So these are the problems of the world. The world is back in the hands of politicians. They have to redesign Europe. They have to bring more jobs in the US. They have to find a new IMF and a new World Bank and a new world reserve currency. They have to do everything, the politicians. Finish the free markets, because free markets in a lot of minds of politicians have proven that they are not capable to bring equilibrium in our economies and growth. So huge responsibilities. In the meantime, growth in the East continues. Average growth of Europe and the US, 2%. Average growth of Asia, 8 to 10%. And that continues for years. Despite bubbles and despite crisis, it just continues. And you see how the world economy is changing every year in a dramatic way. Last slide, and I have taken too much time, I'm terribly sorry. Last slide. In my mind, what we have seen here is not a crisis, but is a revolution. And I could compare it with the French Revolution, 1789, which was also inspiring Washington and Jefferson and all these big American politicians. Well, the French Revolution in France until 1789, the king was the boss. The citizens had to obey the king, and the church helped the king to make the citizens obey. And then suddenly in 1789, the citizens say, we think we have to change. We think that in our society of the future, the citizens have to decide, the king has to obey or disappear, and the church should be specialized on its core business, bring us all in heaven in our next life, but not in this one. And then you start with the French Revolution, and it takes 30 years. And sometimes the king obeys, and sometimes he disobeys, and he loses his head. And then you try with Napoleon, and then with the Directoire, and then with the Consul, and then with Robespierre with his guillotine. And after 30 years, you have a new model, a balanced model, where you see a democracy with the parliament, the government, and a future also for religion and church, but in a new balance. This is what the world is looking for. What is the new balance? And the citizens who are today, just like the French in 1789, are saying, we do not want to continue as in the past. Are not the US, is not Western Europe, but is the emerging world. And the good news is that everybody in the G20 is around the table trying to find solutions about banks, about trade deficits, about the world reserve currency, about global warming. The agenda is huge. And if you look at the meetings of the G20 and the declaration, the press conference at the end, you should read that. It always starts with, we, the leaders of the world. We have discussed A, B, C, D, E, etc. And the last paragraph is, and we all agree that we disagree. But we will continue to discuss in 2 months. This is the difficulty, this is the big task where all these politicians are headed to preserve the globalization and all its good things and the free markets, but in a balanced way where every country, every emerging and developed country finds its balanced place. Thank you very much.
Thank you, Dr. Vanden Spiegel. Just wanted to quickly mention that President Hu Jintao's favorite brand is New Balance. Think about that. I wanted to echo Dean Salzenberger's in expressing my deep appreciation to our group of esteemed panelists. This is a group of very, very busy people who have made time for us, who have taken time from their very busy schedule to join us. Andy is coming from Chicago, and Mike Van Handel is actually my partner in crime, one of the co-designers of the program, and Ulyss is a pillar of support for Marquette University. You have seen his name all over the place. I really appreciate all of you joining us. Please join us in the stage, and the way we go about this, and before I get to that, we've actually bought a lot of heavy appetizers, and if you guys don't eat after the presentation is over, we will have a food crisis on our hand too. So the way we go about this, each panelist will take a few minutes to share with us information about his own background and the industry and the company that he works in. And Dr. Vanden Spiegel kindly moderates the panel discussion. Thank you.
So Ulis, could you start
Okay.
and give your views and reactions?
Well, I'd say my perspective is just from what I've seen on behalf of our firm and our clients. And some points that you made, I think, are ones to take away, that everything changes. And it's a global supply chain that we all participate in. To comment on Europe in particular, I'd like to give you a view from China's perspective, because we, matter of fact, over half of our employees of our firm are Chinese nationals. We've been in Shanghai since November 2004, and we've seen the change. You know, China, you say, well, you know, what's this got to do with Europe? It has everything to do with Europe because it's a global supply chain. We found that the movement of a development of a middle class in China has converted, in a real way, converted the world's factory into a consuming engine. And of course, Europe is China's leading trading partner. And so now we see it, when Europe has slowed, it has affected China. It's required them to provide their own monetary stimulus, and they came out very strong, probably stronger than the US. They were very committed, and now their rate of growth is probably 8% they envision, which is a heck of a rate of growth. But again, what does it have to do with Europe? You know, Europe is tied to China. Volkswagen just announced a big plant. They're going to the western region, an autonomous region in China. This last week, the China Investment Corporation, which is their sovereign fund, one of our first employee in China, works for them now. They basically, I think, Thames Water system in the UK, a major investment. So the accumulation of not only dollars by China, but the euro by China over the years, by selling to China, has put China in a major position to support the economy both here in the US, I think, and in Europe. So our perspective from what we see is that China is probably more important to the recovery or resolution of this crisis, both here in the West and particularly in Europe as we move forward.
Yeah. Hey, Mike.
Sure. Yeah. Maybe give a little bit of perspective on the labor market. So Manpower Group is a $22 billion organization, really focused on putting people to work, both temporary employment and permanent recruitment. And so we're in 80 countries, but the unique thing about us is about 70% of our business happens to be in Europe. So I'm not sure that's the mix I want right now, but that happens to be the mix we have. So we really see what's happening in Europe, and I would say, you know, when we look at what's been going on the last, let's say, couple of quarters or several months, you know, business in Europe generally for us has been slowing down. So we have overall about 300,000 people we have out on assignment every day working for our clients, and you know, things are gradually slowing, as opposed to the financial crisis when you know fall of 2008 things just really hit bottom. Companies just stopped operating, stopped working altogether, and just really sent their employees home and said, you know, we're done. We got to wait and see what's happening. Now what we see is a little bit of uncertainty, a little bit of caution. Our business is down in most markets across Europe about 10% against the prior year, but it's very slow go. And one of the interesting factors, I think, is there's a little less nervousness, at least what we sense on the ground today from our clients, than what it was 3 or 4 months ago, before there was any plan to solve the Greek issue. And I think with that came, okay, maybe there's some political strength and some political thought that you know, Europe is actually going to work together and keep the union together and move forward. But certainly that has been a change. I think the one big difference as we look across Europe is Germany, which Doctor talked about, and there We've got a different problem in that Germany has been so successful. We have a hard time finding the skills in Germany to put the people to work. So we're a bit constrained to find the right type of skills and the talent we need in Germany overall to keep that moving. But one of the things that we see overall in the labor market happening is what we would consider a secular change in terms of how companies are managing their workforce. Overall, companies are very reluctant to hire permanent staff at this stage, particularly in Europe. And so as they look at how they're managing work, they're thinking about, should my workforce be 5% flexible, 10% flexible, 20% flexible? We're having many more discussions with our clients about what is the right complement, because we really need to get more flexibility into our overall workforce so that we can deal with what's probably going to be a much more rockier situation. And let's face it, given the political dynamic, companies just don't want to make any bets in terms of where things are going. So there's much more interest in flexibility, which of course helps our industry overall. And I think as I think about Europe, I think that's one of the big challenges that I see is the lack of flexibility in terms of once you hire an employee to reduce or terminate that employee is just extremely expensive to do that. And really not competitive with the rest of the world. When you look at the cost of firing and terminating, you look at the cost of the social side of work. For example, in the U.S., for every dollar of labor, we've got about 15 cents of social tax on that. Many countries in Europe have 50 to 60 cents of social tax on that. So the social dynamic as well really raises their labor costs. So as we think about the world and think about the global economy, clearly it's a global market, and companies are competing for talent globally. You certainly see that, and which is really a big change we've seen in the last 5 years. And so I think that's one of the dynamics that we look at. We're concerned about is how does the world, how does Europe move from here to really become competitive with the other markets of the world, the other emerging markets, which have a lot of skill and a lot of talent that they're ready to offer. So just a little bit of perspective on the labor market.
Okay, thank you. Andy?
First of all, I just want to, Freddie, you did an awesome job in that 30 minutes, so I just want to have another round for him. Some of myself, I mean, I do this all the time as well, and his synopsis was so succinct and great. It's just, as a fellow presenter, I just want to say that was really fun for me to sit through. I also want to do a little self-promotion. You guys, do you know I have my own television show? Friday nights, CNBC, 4:30. Tune in, okay? We talk about this stuff all the time. We talk about international things that are going on, and it's wonderful that a university the size of Marquette has this type of program for you. You don't know how great this is. And you go around the world, it's hard to duplicate this at its size, so you get this immediacy. So this is great for you guys. I'm the bank's global currency and public policy strategist, so it's kind of a broad area to cover. But about 4 or 5 years ago, I was sitting down with my CEO, and my background is in currency trading, so we're always looking at dynamics of what's going on globally, how it's impacting currency values in the markets. And we agreed that we thought that the government was going to do a significant shift into the private sector. We saw the coming of the end of the Bush era in the United States, and somewhat laissez-faire, although it really wasn't. But certainly from a regulatory standpoint, we knew things were going to change, and we could see some dynamics coming on. I had no idea it was going to get this bad. I mean, government has really been on steroids since 2008, and they've made a lot of mistakes, whether it's the United States expanding its budget and its deficit to just catastrophic levels, which sadly for everyone in this room, you really need to be part of addressing this. This is beyond unsustainable. It's absolutely dangerous, and it will impact everybody here as far as the growth levels of this country and whether or not you guys have jobs coming out of school. So if you don't think your vote matters, you're wrong. It matters absolutely, and you should back the candidate you think is going to do the best job on that front, because it will impact you. So keep that in mind and do vote. With that perspective, I mean, I look at the financial markets mainly, but I also look at how politics impacts them. And as Freddie said, I mean, it's really now we've moved from just worrying about economics to worrying about how politics influences the markets. And he did a great job going through the housing crisis in the United States. You know, in my analysis of things that I look at, there are a lot of good papers out there, a lot of great research that's done. One that I would suggest for everybody read in this room is called After the Fall. This is written by Reinhart and Reinhart. It was presented to the 2010 Kansas City Federal Reserve Jackson Hole confab that they do. But it's great. It's about 40 pages long. Type that in, type in PDF. It'll pop right up for you. It's free. But what they do in there is they go through financial crises over the last really about 50 or 60 years and kind of give you averages of what's happened. So in a financial crisis that pops like we've seen in the United States in 2007, 2008, you have a 10-year period where you build up that leverage within the economy. Credit to GDP expands at about an average of 38%, and then it spends 10 years going back down the other way. So in the grand scheme of things, if you're looking at the United States and how that looks, we've ramped it up going all the way up to about 2008, and we're just starting to go back down. We're only about halfway there. So that means we're having more deleveraging going on, more consumers not spending at the levels that they were back in the early parts of 2000, and that means less economic growth. As you know, as students here, you know that the U.S. GDP is about 70% of consumer spending, right? So if they're kind of constrained, then the economy is kind of constrained. So you're not going to see these growth levels of like 5 or 7% GDP. You're only going to see 2.5%, 2% growth. As a matter of fact, on Friday, you're going to get a GDP number here in the United States for the first quarter. It should be somewhere around 2.2%. The point that I'm making on this is that if we look on average, right, real estate prices in the aftermath of a financial crisis drop 15 to 20%. And really don't recover for at least 7 to 8 years afterwards. So if we're fortunate, 2007 is when the bubble popped, 2014, we still got a couple of years to go on this. And if we look at Europe, so if we're going to go shift from the United States to Europe, Europe back in 2008, they weren't the epicenter for the financial crisis that occurred. Obviously, it was predicated on what happened here in the United States. But they also didn't really address the problems that they had at that time, certainly not from the banking side of things, and certainly not with Spain. Obviously, they're somewhat of the poster child for housing crisis in Europe as they overbuilt, and now they're having serious problems with ever getting back to growth. So my belief is that they never addressed it in 2008, or certainly were trying to get through it. And that was a wonderful timeline of all the things that were happening negatively for Europe that Freddie put up there from 2007 to the present date. What I would add is this, is that this really now comes to a point where they have to make a decision on what they want to be when they grow up to some extent. Whether this is the French Revolution, I don't know. I thought that was another great example. I hope it's not 30 years. That would be rather depressing. Although I kind of like the Robespierre guillotine kind of aspect of it. But I think that they're going to struggle with this because they have labor inflexibility, as what Mike was saying. That's one of their major problems. You can't hire and fire people because it's so expensive in Europe. And that's one of their problems. They have a kind of a different social model or contract with the voter that has a huge social safety net. And that's a problem because you can't get people wanting to hire. You don't have that animal spirits to the extent that you do in the United States, and that's a problem for Europe. So my view on Europe is that it's going to continue to build on problems here because they can't get the growth they need. So growth is really key, not only for generating jobs and GDP, but of course for generating the key thing that all governments need, and that is money. They need tax receipts. That's the key, right? If you have somebody who's working and contributing, paying taxes, right, that's great. If that same person is not working anymore, all of a sudden they're drawing on government social services, it's the negative effect, right? So that's a major problem for Europe. How do you get growth? How do you do it? There's another really good paper out there called Expansionary Austerity. This is by three IMF guys. Again, type it in, pops it up. It's a little bit technical, but it basically comes down to the choice of what do you want to do? You either cut spending, right, or you cut or I'm sorry, you either cut spending or raise taxes. Okay, if you cut spending, the downside to GDP is like minus 0.5%. If you raise taxes, it's minus 1.5% impact, downside multiplier to GDP. And that is the debate that's going to go on in this country right as we get into the election as well. Do we cut spending or do we raise taxes on the wealthy? Right? That's kind of the dynamic that's in play here. So you really have to ask yourself, well, what are we going to get for each one of those moves? And the same is going on in Europe right now. How do you manage that process? How do you get growth? Where does it come from? Because if you're in austerity, it's almost impossible to generate economic growth. So my belief is that the European Central Bank is the only institution out there that can do something. And they will. They'll be forced to cut interest rates relatively soon down to zero and supply the market with a ton of money for their banks. If they don't do that, then I think the analogy to a revolution is quite accurate. Actually, I just wrote today, I write something every day on the financial markets and policy and politics. If you want to get it, you can just go to andrewbush.com and sign up for it for free. Doesn't cost any money. No one's going to try to sell you anything. What I would suggest is that today I wrote something that said rebellion in Europe, fiscal rebellion, because that's what's happening. That's why the government in the Netherlands failed. That's why you're going to get a socialist in France as their next president, is because the model that they've come up with can't work the way that it's structured right now. You can't have all austerity, meaning government cutting back and people losing their jobs. They're not going to take it for very long as voters, and they'll change whoever's there. So I think we're going to get more crazy towards this summer. Spain could be a flashpoint, 23% unemployment. The suburbs in France, out of Paris, I'm sorry, places where you have 50% unemployment for people between the ages of 18 and 24, it's rather dangerous. I mean, it doesn't take much to ignite this. So I would say I'm concerned about Europe right now. I'm concerned about a lot of uncertainty, but also social angst and anger that's going to be directed at the politicians shortly there. So that's kind of depressing. Sorry. But that's what I think.
Okay, thanks, Andy. Elise, you?
I have a question. Just talked about the role of central banks, right?
Yeah.
Because the latest numbers are that the People's Bank of China is largest in terms of total assets, they think now, about 4.5 billion. ECB is the next largest central bank balance sheet in the U.S. What's the role of the central bank? We talk about the need, you got fiscal policy and monetary policy. You have to, what we've done here in the United States is to make sure the economy didn't stall, flooded with money. You just mentioned, Andy, Europe's going to do the same thing. What's the role of central banks as it relates to macroeconomics, but also to the politics?
Yep. And more specifically, the ECB, you mean? Well, the ECB is, again, in that whole political construction of Europe, is a very special central bank, which leads to the dream was, let's start with a single currency, and the political union will follow automatically. That was the dream of the president of France, Mitterrand, 20 years ago, and of Kohl, which was the chancellor of Germany at that time. Now, the currency is there, quite successful, well managed by the central bank, but the political union did not follow. And the treaty by which that central bank was created gives a very narrow mission to the central bank. They are not as flexible as Mr. Bernanke can be with the agreement of the government to suddenly say quantitative easing, I'm going to print money and I buy government debt to fund the deficit of the US. It's forbidden. Literally in the Treaty of Maastricht, 1992, it's forbidden that the central bank should help any country in difficulty. So this is where the political construction of Europe is not fit for a crisis. Because at that time, the puzzle does not fit in Europe. Now, in the meantime, of course, the former governor, which was Mr. Trichet, has then been followed up by Draghi, the new governor. In the meantime, they see that it's now 4 years of problems in Europe, and then they start to find pragmatic solutions on the edge of the treaty. For example, what Mr. Draghi now is doing is saying, I'm not going to buy the government debt of Spain or the government debt of Greece. I'm not going to do it. But what I'm going to do is to give an unlimited amount of money to the banks, and then trying to convince them that the banks buy Spanish and Greek debt. So this is the way Europe tries to get around of its own treaties, which are always bad compromises of a lot of politicians sitting together for weeks. So you have the two things happening in Europe. Try to muddle through with the limits of all the political problems, knowing that each of these politicians wants to be re-elected. Mrs. Merkel doesn't want to be the helping angel for Greece because she knows that her population, the Germans, don't like German savings to be spent to help Greece. They say they have danced the sirtaki for 20 years. It's not our savings that are going to help them. It's their problem. And the same happens in more countries. So you get nationalistic movements.
Definitely.
And there you have now the new French potential probable president, socialist, Mr. Hollande. It's not very clear. The French President Sarkozy and Merkel, they were a fine tandem. They agreed, and it was not because normally in Europe, the driving force is the European Commission. They propose things and they push. Well, this time, since the crisis, the European Commission is silent because they don't have any mandate. The crisis is not in their toolkit, so they can do nothing. And who has really moved in Europe is Sarkozy and Merkel. They have pushed everybody to do what they had to do. Now the question is with Mr. Hollande, what will now be the consequence? Personally, I'm not too worried. Well, I am worried. That is what you have heard. But it's perhaps not too bad to have an intelligent socialist as a president of France.
As opposed to unintelligent.
Those are not two words that are used in the same sentence, actually,
Well,
for the most part.
if you look at the past in France, you had Mitterrand, who was an intelligent socialist, who partly has exactly done the opposite of what he promised to do. In order to avoid the social problems. Because for a socialist, it's easier to do the things that he would never do if he would not be a socialist. So perhaps we'll see what Mr. Hollande, if he wins the second round, which I think, what we will do, and that the tandem with Merkel will continue. In the meantime, the ECB is trying to do what it can. And the ECB has been very clear. When I talked about the triangle and the fact that weak member states get weak banks, that weak banks have to be rescued by weak member states, which become then weaker, and then you get the spiral. Well, the ECB has clearly said Europe has to recapitalize its banks. That's what the US has done in 2009. In a dramatic way, that's what Andy told, that Europe has not done yet. And that has to happen. That's the first step. Good news is that there is now 800 million euro ready in a new rescue fund that can be used or to help poor countries or countries in difficulties and to recapitalize banks. And my guess is that a lot of that money will be used to recapitalize the banks. Once that is done, then that downward spiral is stopped, and then I'm not so sure that there is no reason for more optimism for Europe. But there are a lot of ifs, and that's a problem.
Yeah, I got 5 in that last sentence.
Yes, yes, that's it.
I'm not as much of an optimist. I mean, I don't think the solution for a debt problem is more debt. And I'm not sure that the IMF doesn't have the money quite yet because the U.S. has to agree to it, and that's not going to happen until after the election. As the U.S., you guys probably don't know, the IMF, to get any change, you got to get 85% of the members who pay into it to agree to it, and the U.S. has 17% of the vote. Unless the U.S. agrees to it, it's not going to happen. But what I'm excited about Europe is, and I'm just kind of curious, I mean, do you think, and I want to ask Mike this because he's kind of on the ground floor there, but what is cool about what's changing, I don't know if you can use those words in the same sentence, but there would never be these changes in Greece unless there was this crisis, right? they had a closed economy. It was like the people that had already, were in their privileged places, whoever had their licenses for the trucks, whoever had the license for a law degree, those guys were golden. It's everybody else who was trying to get into that group, you're shut out because they block you out via regulation, or you don't know the right person, or you haven't bribed the right person. Now that's being broken up. And that's what, to me, even though Greece is still quite a disaster, what I'm interested in asking you is, have you seen anything along those lines where people maybe, something dynamic could be going on there?
Mm-hmm. So I wish I could say we have. I'm not sure.
We're just a happy lot here.
I'm not sure we've seen that. I do think it is moving towards those who have the skills will get the work, and I think that is one of the things we're seeing, not just in Europe, but really every economy is a real bifurcation in the labor market per se, and that is another worry that I won't get into now. But clearly, those people that do have skills are very employable, and those that don't, we're finding along the sidelines. And I think if we see economies like Greece open up, have more flexibility, I think those people probably have a much better opportunity to get employed. So I think there is some possibility for that. One of the challenges is just getting that workforce up and get the low skilled with the necessary skills, and that's not necessarily a 4-year education. In many cases, that's just a technical degree, some skilled labor training. Those type of skills are in need. They certainly are repricing because, again, we're in a global labor market that's competing globally, and those skills are repricing overall. And I think every economy we see, every developed economy is feeling that those jobs where I used to be able to make a good wage doing X, now I make a good wage doing, now I make a wage which is the good wage plus something doing the same thing, same type of work. So there clearly has been a movement, particularly in those less skilled type of jobs.
I have another question.
Yeah, please, Alice. Yeah.
Wait, Ulyss, you got to answer
No,
some
no,
of
no,
these.
I'm going to school, man. This is
Freddie, stop
This is
him.
good. On currency, we talked about central banks, but on currency, since that's your stick, right?
Sure.
So there was a lot of talk about, the potential of the euro blowing up, right? I mean, the risk of it blowing up, and the thought was if Greece goes down and Portugal goes down, and at the time Italy was a little rocky, stronger now, sounds like. But what's the potential impact of that happening? And for me, on the currency side, you talk about euro in the history and sort of the collage of the European Union. The fact that the British pound does not play is not part of the euro, right? It's separate.
Right.
And I remember, and I studied and lived in London a long time, the British in the continent view themselves differently. So how can you really have a solution in Europe when you've got two currencies, really major currencies, right? So euro and the pound. And you have some political and social, World War I, World War II, fought each other, still don't like each other to a lot of ways, right? I mean, candidly. So how might that affect the currency?
Well, this is a question that's running around the marketplace right now, is like, for instance, could Germany pull out of the euro? I mean, that's one of the questions that I get asked. I just had an investment banker ask me that question today. And you have to understand that it goes beyond just, oh, Germany's great and they can do whatever the hell they want, right? Because they're tied into Europe. Think about this for a second. We always talk about banks, because banks are the funding mechanism for growth in Europe much more than they are in the United States. So if the banks aren't lending in Europe, it's a problem. You're not going to get growth. You're not going to get access to loans. But take a look at Germany. Let's say they went back to the Deutschmark. What would happen? First of all, their banks would lose a tremendous amount of money. So would many of the companies there. Why? Think about it for a second. Why would they lose money? They own stuff outside of Germany, don't they? Right. So if they go back to the Deutschmark and let the euro go, what do you think the rest of the people that are part of the euro are going to say? Happy days, let's devalue this sucker and see if we can grow, right? Because throughout history, when you have restructurings or defaults, right, it's always the double Ds, right? Default and devalue. But you can't do that in Europe, because they're tied into the euro, the straitjacket there. The other thing that I would say, and maybe this wasn't part of Freddie's presentation, but Germany is a major exporter to the rest of Europe. Right? If you look at their growth rates through the 2000s, it is extraordinary for their exports. A lot of that did go to China, but a lot of it went to Europe as well. If you're in part of a union, right, where your competitors are tied to the same currency, they can't devalue, which is what happened in Italy all the time. I mean, I used to trade the Italian lira. It was awesome. They would always default to devalue, and governments would change. Or I think at one point they had changed a government in Italy every year since World War II. You could count on them. It was great. They'd change government, the currency would devalue, you'd make a lot of money selling their currency. But they can't do that now. So it's a different game because of that. So the Germans have a very vested interest in keeping this whole thing together. And remember, the big thing is it's a free trade zone. They've dropped a lot of barriers. They've harmonized some tax structures. They've harmonized a lot of regulations. It's in everyone's interest to keep this going. They just have to figure out a way to keep it going. And I'm not sure how that's going to play out. My theory is that the central bank has to ease dramatically. They have to allow inflation to go up, because that's the only way you're going to get growth. And because you're tied to one currency, you can't devalue. And devaluing, that's how you cheapen your labor costs, isn't it? Because if you're in a country that devalues the currency, all of a sudden, labor costs in that country go down by probably almost exactly what the devaluation is. Now, with a tied currency, they can't do that, so labor has to adjust by actually the price going down overall. And that's pretty tough on the people. So the only way I see out of this is for the central bank right now, is the only central body that can act there, is to cut interest rates and pump a lot of money into the economy.
Well, I do agree that the problems of Europe, of course, it's a political mess. I've explained that. I also said in one of the last slides, the euro collapse is not, I think, something that is probable. You should not forget, if you say the Greek problem, it's 2% of the Eurozone GDP. Bailing out Greece is almost peanuts. Portugal is less than 2%. Ireland is less than 2%. Ireland has already made the turnaround, is now competitive and is exporting. Portugal has made more or less the turnaround, but less convincingly. Greece is bankrupt. It has not led to the destruction. All analysts, and certainly all those in London, were saying Greece bankrupt and you have chaos in Europe. It has not happened, because it's peanuts. You have to control it. What I think is the political willingness, despite all the unrest in a number of countries, the political willingness to continue with the euro is still there, for the good reason that Andy gave. It's not a win-lose, it's a lose-lose if you leave the euro, for the weak countries and for the strong countries. But what I do not exclude is that once the dust settles, that some countries will not be able or willing to play according to the new rules of Europe. One of these new rules is that a country can never ever have a deficit anymore. So for the future, if that is implemented in all member states, the problem of huge public deficits and debt will, to a large degree, be impossible in the future. It's all in the cards, but it will take a lot of time before it's implemented. But I'm rather optimistic for the euro. And then if you say, what is the future of the euro? Against what? Against the yuan?
Yeah, no, because basically you've got the dollar and the euro, and the yuan wants to get in there to make sure that it has a role, right?
But the future of the euro against the dollar depends as much about the future of the dollar. Right. And that depends on a political decision in China. Do we continue to support the dollar and to peg the yuan? Now, if there's a political decision to stop that, because to continue to accumulate dollars is a never-ending story, where the pain for the future becomes bigger and bigger, well, then suddenly you have another picture. Now, continuing on that, if you see that currencies and economies are so vulnerable on political decisions somewhere else in the world, what do you do as a manager? The times of just-in-time and the value chain optimized. What do you see in the US? Do you see already companies reflecting on, should we continue with that value chain worldwide and global, or should we protect ourselves against regulatory, political problems, and trying to get back part of the value chain in the US? Do you see that? Or?
Well, what we see on behalf of our clients, and we're lucky to have some global clients, you go, they say you fish where the fish are, right? So you look at Asia, the rate of growth, 8+, the numbers are there. India, $1.1 billion, China, $1.2 billion, $1.3 billion for some time. And so, you know, the global supply chain moves there. Like we've got clients looking for, they call it the in China for China strategy now, right? You know, so that's moving. And then as a result, some of our clients are tier 1 and tier 2 suppliers of the large OEMs. OEMs say, I made an acquisition there. If you want to keep supplying me, you've got to get there. And so I think ultimately that affects currency. If you look at the renminbi or the yuan against the dollar, it has grown stronger over the last 5 years, right? Not as much as people thought, but I remember 7 years ago it was 8 to 1. Mm-hmm. It's 6.2, 6.3 right now. And they've managed that. I think they managed it pretty well. So to me, I think there ultimately be three major currencies. The renminbi or the yuan is going to get there, mainly because they have so much of everyone else's currency. They could kind of set the game. Most recently, they just announced 2 weeks ago that they were going to allow the Bank for Reconstruction and Development at the IMF to now buy sovereign debt in China. Okay, as they're starting to open up their markets, you're seeing debt traded on the Hong Kong exchange now. Mm-hmm. Yep. So the goal is to allow their currency to become a top shelf currency. And I'm not sure ultimately the real effect of all oil being traded in US dollars, right? I mean, to me, that's a subtle thing that will always keep the dollar a major currency.
Yeah, okay. Mm-hmm. I would like to give you the opportunity to ask one or two questions if you have. Yes, please, you, sir.
Yeah, I have two parts questions. One is about Spain, and the second one is about big European banks. One, as you mentioned, their labor cost is a lot higher than Germany, and their unemployment rate is really high. And I heard from some people that they're expecting housing price would still come down more than about 30%. Do you see any threat of them going down in this year or next year? And is it even, are they too big to fail, or any other countries in Europe can even save them? And the second question is, would big European banks like BNP Paribas or HSBC, would they ever be able to reach their like 07 level with interest rate changes and things like that?
Yeah. Well, indeed, I mentioned already the problem countries until now are really small countries like Ireland, Greece, and Portugal. Spain is a bigger thing. There you get to something for which you need 1,000 billion as a wall of money to protect that country from collapsing. We are not there yet. There are very contradictory signs out of Spain. The housing market, most analysts in Spain think they are close to the bottom. It could come down a little bit, but they have already done the major part of coming down. Something that is now starting to be problematic for Spain is that a lot of exposure they have in Latin America, Brazil, Argentina, where these countries are now getting into protectionism, which could again hurt Spain. Until now, the general feeling is that indeed, if Spain would fail, there is enough money to rescue them for quite some time, but an economy of the size of Spain has to be able to do the turnaround themselves. And there you get into the social problems. It will not be without any pain. That's for sure. That's for sure.
The only thing I'd add to that is Spain has a really crazy fabric of levels of government that they have to change. They gave a tremendous amount of autonomy to the states, and it's caused all sorts of problems because I think there's like 5 layers of government workers that are overlapping each other with overlapping regulations. I mean, it's a disaster. So they have to change that, and they know that. They're going to try to pull some things back politically. That I think, again, you know, I try to be a little bit more optimistic than most people end up who cover this stuff, because if you really cover it a lot, you go home, you seal up the windows, turn on, make a little macaroni and cheese, seal up the windows, and turn on the gas, right? I mean, but I think there's some positive things that are happening.
Yes, please, on the back row, and then we take the second question immediately after.
A question about China and how they're achieving such amazing growth when they're truly politically a command economy. So how is that working for them over the last 20 years? And to me, that tells me that really they're moving more towards a free market economy. And the United States and Europe tend to be moving more towards a socialist economy. So are we moving in the wrong direction and China's moving in the right direction?
Okay. And the second question, perhaps here in the middle, the lady.
Unrelated, but what impact does the Eurozone crisis have on the international oil market, either in terms of supply and pricing, things like that?
Okay. So 2 questions, one about the...
I think Ulyss has to answer a question.
Yeah.
I haven't heard
One thing about China is that China works on 5-year plans. They just announced their 12th 5-year plan. So that's very fundamental, and yet the Communist Party, People's Party, governs China, but basically they have a Politburo that says, here is the plan for the next 5 years, and they push the plan down to provinces and to the cities, and so it's kind of a controlled economy. But because they joined the WTO in December of 2001, there's an 88-page accession agreement where they had to begin to open up their economy, but they've done it in a managed way. So if you go to Shanghai and Beijing, it looks like New York skyline, but yet they've done it in a managed way. A big point about the most recent 5-year plan was called the Harmonious Society, because the concern is that they don't let everybody play. Everybody drink some of the water is going to be a problem. Okay, so basically there was a while there they said cities the size of Chicago, there were 8 new cities that size born every year in China. For the agrarian society coming into the urban market, TVs, now cars, automobiles, they're slowly, gradually allowing the middle class to grow. And whether they can manage it, I'm not sure, because typically human behavior is hard to manage. You can kind of make a move here and then wait to see what happens. So far so good, but I think you're seeing now in the change, because again, every 5 years, well, there's a new president that serves for 2 5-year terms, okay? And so a transition is taking place at the end of this year, early next year. And as a result, you're seeing some prosecutions of elected officials, senior party officials who were laying kind of fat on the, on the lamb there, and now there's a change coming, and their support in Beijing is being taken away as new people come in. So there's a natural progression taking place, but to me, it's not a free market. They play as if there are a free market, but I think that the market forces of a global economy are forcing them to open up their system, and they agreed to with the WTO in 2001 that they had to make this move.
Okay. Thanks. Any reaction to the other?
As far as oil goes, it's a real strange market as far as oil. Europe is mainly determined by Brent crude, the price of Brent. And that's been impacted by a lot of what's happened in the Middle East. And Africa, obviously, with the Arab Spring, also with what's happened in Iran cutting off their supplies. So we have a spread of Brent to West Texas Intermediate be fairly high, and so you have higher oil costs there. In the United States, we have higher oil costs than what we did a couple of years ago, but it's a little different game. We have a tremendous amount of oil here. Oil supply, we're awash in oil in the United States. Our problem as far as it driving gasoline prices, which I'm sure affects everybody in this room, is that there's a couple things going on. It has to do some with regulation. It's really tough to build a new refinery in the United States. You've heard of NIMBY. It's damn near impossible to do it. Yeah, you're not going to be able to do it. And the other thing is that some of the refineries are older and they're shutting down. And you get in this transition period. I don't want to get too much into this, but in the lead up to Memorial Day, you go from winter blends to summer blends, and gasoline prices almost always goes up over this time frame. Also in the east in the United States, they're shutting down, a couple of the companies are shutting down refineries that got oil from Europe because the oil was so high and the cost of it, they couldn't compete with the oil that we're getting out of Bakken out of North Dakota and also from the tar sands in Canada. So this is really cool though, right? Oil production in the United States is amazing. Natural gas production in the United States is amazing. You know, it has really helped temper the cost to consumers, right? Electricity has been relatively cheap because of natural gas. Your summer electricity bills are going to be much lower than they normally would be because of how much natural gas is out there. And just real quickly, why has that occurred? Because of technology, which gets back to what Freddie said at the beginning of it. Technology drives so much of what's going on in this country, but hydraulic fracturing to release natural gas and oil has been a huge boon for consumers and for the production of oil and natural gas, as has horizontal drilling. So while you're hearing a lot of bad things about those things, let me tell you, it's fantastic because energy costs in production are so much higher and they're creating a lot of jobs and it's helping consumers overall.
Okay.
Can I get 1 minute? Can I get 1 minute? Just, I'm learning. I'm going to school, man. I went to school here too, you know. So bringing it back. This room wasn't here back in the day. but on the natural gas, because right now you're right. Natural gas prices, I think they went below $2 per a million BTUs for the first time in a long, long time.
Right.
But you talk about electricity. You have a lot of coal-fired plants around the world, right? That's where the carbon footprint's a big concern. But there's a lot of coal, right? So most times you'll see most power generation, electricity power generation plants are coal-fired, right? And so when you see the natural gas going so low, they'll start to convert those plants to natural gas-fired plants. But what about the coal industry, right? What about the impact on coal?
Obviously it's been negative, right, in the United States. Yet, going to where you do a lot of business in China, that's what we can pull out of the ground and send it over there. That, you know, it's a cheap source of fuel, and the Chinese have a lot of coal-burning plants. Now, that's not great from an environmental standpoint, but overall, you know, it's interesting how things shift around. You know, you're gonna see a lot more natural gas plants being built globally and in China as well. But this technology that I just talked about has not really, gone out as much as it has. Like in the United States, it's prevalent. For the rest of the world, they're just getting this technology. So I think from an energy standpoint overall, I think we're going to be in much better shape going forward. We burn natural gas. That's obviously a lot cleaner than coal. But I think eventually the price of coal has got to continue to go down and follows natural gas. And that's generally the way it works.
Okay. Ladies and gentlemen, I think we should close this discussion. At least here we can continue over there on this very optimistic note.
Yes, really.
So at least there is some optimism. Thank you very much to the panelists.
Thank you. Before we leave, I wanted to ask session for us.
Well, thanks everyone. Those were terrific questions, and I'm sure you have many more. Dr. Hosseini said there will be many lively discussions outside afterwards. I would like to thank each of the panelists. As mentioned earlier, we recognize that you're all very busy and have a lot of other commitments, and it means a lot to our students and a lot to Marquette and the College of Business Administration and the Graduate School of Management. So we have a small token of our appreciation, and let's show our appreciation one more time for our guests.